Welcome to the Economic Rockstar Podcast with your host, Frank Conway, connecting brilliant minds in economics and finance.
Hello and welcome back to another episode of the Economic Rockstar Podcast. This week's episode follows on a mini-series that I'm doing at the moment, which is on trend following, a type of investment strategy in the commodities and financial markets. And if you want to know more and follow the previous episodes on trend following, check out episode 140 and 142. If you've just joined us for the first time and have found the podcast recently, why not check out the back catalogue of all episodes on economicrockstar.com/podcasts. And if you haven't done so already, why not check out Apple Podcasts and leave an honest rating and review, and subscribe and never miss an episode. Or subscribe to Economic Rockstar on your favourite podcast platform. This week's guest is Mike Melissinos, who is founder and CEO of Melissinos Trading, an investment firm that specialises in the trend following strategy. In this conversation, Mike gives us a very honest and open account of what life is like as a trader and a CEO of an investment firm who specialises in the trend following strategy, and touches on the highs and lows that one can experience with the highs and lows of markets, and how he deals with them and the rules he tends to follow when participating in these markets. Mike has a very interesting personal story, which begins at the time of the stock market crash, where he was a junior analyst at Bear Stearns and J.P, as well as an equities trader for SMB Capital. But it was in January 2011, after his experience during this financial turmoil, that he decided to start up his own firm, Melissinos Trading. And today he manages over $5 million for individuals and institutions. And I wish him the best of luck in the future. So if you want to check out all the links, resources and books mentioned by myself and Mike during this interview, why not check out economicrockstar.com/Mike Melissinos. That's Melissinos. As always, thanks for listening and subscribing to the podcast. If you haven't done so already, check out your favourite platform, subscribe, and get an instant notification of the next available episode. This will help me a lot and will also keep the podcast in the public eye. And the best way to help me get this podcast out there is to care and share. If there's somebody that you know would like to listen to this episode or any of the previous ones that stood out for you personally, why not share with them a link over at economicrockstar.com/podcast, and you'll actually see a list of all 142 episodes. And if you click on one of those, then you'll bring you to another window which will allow you to copy and paste the URL in which you can share by email or text message. Don't forget to rate and review the podcast if you haven't done so already. And if you'd like to help out a little bit more, why not check out my Patreon page over at patreon.com/Economic Rockstar, where you can check out any of the levels that might interest you, in which you can financially support the podcast for as little as $1 a week, and you can opt out at any time. So enjoy this conversation with myself and Mike Melissinos of Melissinos Trading. Hello, Mike.
Frank.
Hi, how are you?
Hey, Frank. How you doing, man?
Good. Yourself?
Good. You know,
yeah.
Markets are still shit. So trying
well,
to.
I shouldn't be laughing now, you know. Yeah.
Well, I think you have to laugh, because if you take this too serious, man, I think you'll just crack up.
Yeah.
I mean, it is serious, right?
Yeah, it is serious.
It is real money. It's right. Yeah. It's all that stuff. But I believe a lot of times we're just operating in a universe that's just so out of our control that, you know, there's a great amount of luck that's involved too, at least in the short term, you know, and that short term could last like 5 years.
Yeah. And the luck you probably talk about perhaps is the timing issue as well. And when you get into it and.
Yeah. Well, you know, I've become pretty good friends with Jerry Parker.
Okay. Chesapeake.
Yeah. The turtle guy.
Yeah.
You know, he started in, before I was born in, 1983, I believe. And then he started Chesapeake in 88. And I believe he had one losing year from 1988 to 2011. And 2011 is when I started. So since then, though, he's had 4 losing years, you know? Yeah. So he's had 4 in 8 and had 1 in 25.
That's
you know, so incredible. It's like, we talk and it's like, I don't know, man, this could have easily have happened back then. It just didn't for whatever reason. And, here we are now, just kind of suck it up. It's just, there was always the possibility of going through a 5 to 10 year stretch where the returns are pretty much flat, and I can't tell you how many guys that, when you interviewed Covell, how many guys in that book that he profiled that are negative since my inception, which is like January 2011. It's unbelievable.
You'd want to have some discipline.
Yeah, I mean, I feel that there's some guys that probably haven't,
But even starting out in 2011 and you being in those difficult years, must be mentally draining, and at least you're in good company. You have the likes of Ray Dalio and Jerry Parker experiencing similar movements in their portfolio. But
sure,
for someone starting out, like for example, I was speaking recently to Niels Kastrup Larsen, and he mentioned about Ray Dalio, how he traded for a number of years and almost went broke, and he had to borrow €4,000 to start again, and now he's one of the top traders out there today.
Yeah, I think it's just keeping your wits about you. If you just happen to start in a bad time, or you just start and you don't really know what you're doing, and you make a mistake, and then you got to start again. But some people will just say, "See, the market's got me. See, they get everybody. Let's just quit, move on to something else." And you know what? That a lot of people do that. And it is tough because you can start. I say it's one of the few businesses where you could start and the results won't match your ability level. So someone with no ability could start in a really great market and think they're a genius, right? Because this is easy, But and then on the flip side too, you're good. You're gonna be long term good, like Dalio, right? You're gonna be long term good, but right now the results are not going to show that. But no one would ever have that idea of going to an American football tryout. Like an average skill player, a guy off the street who's never played, right? He's never played football before. He's never going to make the team. It's never going to happen. Like he'll have no luck in that game. But in an investing game, you can have a whole bunch of luck and think you're good, So it sucks sometimes when you're on the flip side of it, but, such is life.
But the thing is, if you have a system and you stick to that system and don't move away or deviate from it, okay, you might make a few adjustments and tweaks from a learning experience, but you have to follow that system continuously.
Yeah.
And you will get that break again.
Yeah. It's really just being available for it, just fighting off. I don't know if you watch or know about American baseball at all. It's just like fighting off the pitches, right? Just stay alive, keep fouling it off, and eventually you'll get your pitch. Yeah. And for us, for the diversified trend guys, we've gotten one good pitch, and that was 2014. And maybe for some other guys they did well in some other years, but all of us did well that year. Outside of that, it's like, ugh. It's just all right. Yep, still down. All right. Yep, still. Would
you be more heavyweight on the equity side of things or the indices, or would you have commodities and currencies that are actually hitting you too? Or are the markets just all falling at the moment? Because I'm only aware of the equities right now. I haven't, and oil, I suppose, dipped a bit.
Yeah, I've structured my portfolio since the beginning to be evenly split, so between the financials and the commodities. And I'm more, like Niels, Kastrup Larsen, those guys at Dunn, they're more heavily weighted towards financials just because of their size, and that's just the way they decide to do it, And Jerry too. Jerry's more even. So being more even over the past few years, that is having more weight to commodities has hurt us more because there's been just nothing available. It's all been stocks pretty much that have been the good stuff. That's been the good markets. So in my first few years, I outperformed quite a bit, and that was thanks to the commodities, right? There was more like gold and some other things that really trended well, and that was making more of an impact on me. But since then, it's been, if you've been stocks heavy, like the guys at Dunn, you've outperformed. Yeah. No doubt. Yeah. And there's just really no way to you're going to have to stick with some allocation and then, trade the entries and exits and let the positions sort themselves out depending on the trends. But, bigger firms just have to go where more liquidity is, and that's just more financials and stocks. So that's why they've done well in the last few years, for sure.
I'm just wondering about what you were just saying there regarding entries and exits. How, for example, if someone experiences a drawdown right now,
yep.
Do you continue with that drawdown? Do you readjust? Do you look at certain exits, and if those exits are triggered, or do you wait until if you have a certain time period, for example, a readjustment period whereby you might look at a weekly data as opposed to reacting to the noise today or tomorrow? What derivatives, if you use any, do you buy any puts? Do you short futures to compensate and move with the very short-term trend?
So I think, a bunch of things there. If you start day one with a system, and you have your rules, and all right, you go into a drawdown, I'll do this, or I'll stick to it, I won't adjust anything. But by nature, trend following adjusts all the time. So when you go into a drawdown, you don't need to adjust. At least it's my opinion that I don't need to adjust again. It's already adjusting. It's just the results aren't working out for us right now. There's nothing to say that's wrong with it. It's just, this is unfortunate. This sucks. I'd rather be making money. But I knew that this could happen given all the data we have and then all the new data that we just can't test for. I know this is possible. But, adjusting an adjustable system is just like fancy way of just not doing the system. Yeah. It's just like, I justify it because, I'm making it better. No, that you're just saying, you're coloring it with your own logic that you're just not following it. You're selling yourself a story that, it's okay though. It's okay. Because, I did some research and, I added this new thing in there. So the old system is now done. Now you have this new stuff because a feeling came up that you don't like I don't want to lose anymore. I want to raise some money. I don't want to look like an idiot anymore because the stock guys are winning and I'm losing over here. I better hurry up and do something, make it happen. If you medicate that feeling with, some tinkering, you're probably going to be tinkering till you're dead. It's a fancy way of medicating your discipline. And, I imagine that's going on a lot.
Mike, I'm really interested in your background and how you got to your business, Melissinos Trading. But before you go into that, just to continue on this conversation that we're having right now, on reflection from your degree in, is it Seton Hall University? Is that how you pronounce it?
Seton Hall. Seton Hall, yeah.
Seton Hall University. You did your degree in accounting, and I don't know whether you've done any economics modules in that, or was it mainly finance and accounting? Perhaps you would have come across some theories in there on bonds or whatever it might be.
Yep.
I doubt, unless you're unique, majority of people coming out of university would retain a lot of that particular knowledge, theoretical knowledge. And those who might use it in the future in their career, there's a possibility that they wouldn't. But you're in a situation whereby you are up to your neck in water regarding the stock market and living it. How is it that, if you can relate it back to your degree or whatever you might have come across, if you've done any readings outside of that, does it live up to what's happening in the markets? Or do you have any criticism, or do you find anything that links in really well to it?
I have to say that what I learned in school, I don't subscribe to really any of it. Not to say it doesn't work. It's just not for me. And I don't, in school it was all about the value models and try to find the right price. What's the correct price of this security? And from our fancy models and our forecasting and all this, what should the price be? And that is very different from what the market is saying it is. And for me, growing up in the East Coast here around New York City, we're very, at least in my little circle, we're very straight up, to the point people, and, what are the facts, and what can I go off of here? Like, okay, I got some theoretical model that should tell me that, all right, this is what the price should be. So, all right, it's below it now in the market. So this is an easy buy. All right, that's easy. Okay. Well, it's not so easy, because the markets can have different ideas for what the security you're looking at is worth for a while. And, I studied accounting in school, have no real relationship to the markets per se, but I played baseball there, and I played baseball my entire life, sports my entire life. And that was always, there is no theorizing there. It's just, you have to react to what is. And that set me up to welcome the trend following, trade the price, obey and respect the price today more than anything, more than some theory, more than my forecast or what my models say it should be worth. That word should can get very, very dangerous, because the markets have more patience, more money than you, and they could just do whatever they want until you finally say, all right, you know what? You're right. The price is this. That's probably the correct price. Yep. All right. I made a mistake. Not sitting there pushing on it saying, oh yeah, but it shouldn't be this low. We should just keep buying it, right? It shouldn't be dropping like this. Well, it is. So you need to get on board with it, and you need to respect that that's the truth. That's the only thing that cannot be lied about. And I feel that the trend following philosophy and just the mechanics of it all really clicked with me. So I lost that, I shed that school stuff and that Wall Street philosophy, the buy low, sell high, the, buy value stuff very, very quickly, because as we'll probably get into, after school, I went to go work at Bear Stearns, which is now gone.
Yeah.
And that was my first experience out of school and in the real world and on Wall Street. Was, the Bear Stearns collapse, and then eventually working at J.P. Morgan through the financial crisis when Lehman went down. So I saw it initially that, this doesn't work. This opens you up to massive loss, massive and sudden loss. And this is not going to happen to me. I need to protect myself better. And, that was when, I'm probably jumping ahead here, but that's when I started getting into the trend following readings and all that stuff.
When you were working as a junior analyst at Bear Stearns and J.P. Morgan, you relatively new. I suppose you were in it a couple of years, were you, before it kicked off?
Yeah, I started when I was 23, okay. I believe. So, yeah, very young.
So when everything was kicking off, you probably it was probably fresh in your mind now what was actually happening leading up to the collapse. Or was it quite sudden? Was it unexpected?
Yeah, I think I had, at that point, I was only really new, I was kind of new to the trend following stuff. I had, read Michael Covel's book and, was reading a bunch of blogs and following a couple of the traders, but I didn't really get to appreciate the performance and, the performance in real time, because you could look through books and say, oh, you guys did well in 1980 something, 1990 something. I was like, well, I don't know what that's like, because I was a little kid or I wasn't even born yet. So what does this look like in real time? And then boom, I got it, and I got a big one. And that was an aha moment where, Bear, there was nasty stuff behind the scenes. The CEO was like going on the internal TV station talking to all of us, and at that time, I was following guys like Jerry Parker and, following their monthly performance and seeing, why are you guys doing so well? And we're over here going out of business. What is this? And, maybe I was too stupid and naive at that time. But I remember at some point it clicked in me, and I was looking around the offices and the trading desk at Bear Stearns. I was like, you guys have no idea what you're doing. No one here has any idea what they're doing. They basically just got lucky. They had good jobs riding a bull market for most of their career. And then when a big one, when the bull market ended and they had a big bear show up, no one knew what to do. And that was a huge wake-up call for me, because I love survival stories, and I knew I didn't want to die. I didn't want to end up like this and look this way and run around my hair caught on fire. So, yeah, I mean, I saw it happening as it was playing out before March and then eventually into October. And it was just like one aha after another, seeing the performance of the guys who I wanted to be like, oh, this is it. This is it. These are the guys that got it figured out. But I don't know why no one knows about them, but okay, they have it figured out and I want to be like that. And that was kind of my, where I started to divide the fork in the road, so to speak, started to go that other path.
And you were able to move on quite quickly, becoming an equities trader for SMB Capital too. Even at a time, I suppose at a time when the markets were recovering. But having said that, I'm sure the industry was well shaken too, and there had been a lot of job losses. To get something quite quickly was quite profound,
God. Yeah, it was. I think I went on, I don't know, a dozen or two interviews, and it was just, Mike, we like you. We just can't do anything right now. Because I was laid off in January 2009. All the new guys on the team laid off, and a whole typical LIFO, during recessions and nasty periods. Last guy's in, first one's gone, and yeah, it was really difficult to get a job. But then I just thought, what, these are probably all signals of I shouldn't go this way. And I think during the interview process too, I was like, yeah, I don't know if this is going to be for me. Let's see, let's explore doing my own thing right now. Let's see what that's going to be like. And then I just started going down the path. And yeah, I knew even when I took the job at SMB Capital, it was like a proprietary trading floor, trading shop. I'm sure there's there's tons of them out there, but I knew I didn't want to do that long term. I just kind of wanted to be around other traders for a bit and have some access to tech to do some research and to build and test my trend following stuff. And that was just an easy stepping stone for me. So I probably took a little bit longer than I should have. I think I was ready to launch earlier, probably sometime in 2010, but I was just kind of a wimp about it.
You probably want to be perfect.
I don't know if I can. Yeah, that whole thing. And what happened? I didn't start in 2010 and I missed some good moves, right? Again. And then I capitulated and said, God damn it, I got to start this thing now. And boom, what happens? Start right at the top. So that was another lesson for me to, make me more aware of my feelings and, even to today, seeing like, I'm pretty down in the dumps right now. All right, we'll probably due for a pop, or I'm feeling really good. I got the calculator out, calculating my fees. All right, this is going to be a good big fee this quarter or something like that. And boop, start losing money. So, that was a real good experience for me to, even though I think it was, I was too impatient. I waited too long and then I got really impatient at the end and that hurt me, I think, a bit, but, I think a good long-term lesson for sure.
I wouldn't mind talking about feelings now, the psychology of markets as well and how you actually deal with that.
Yeah.
It is a very important topic and it's one that rarely gets discussed in some books that you might read on trading markets or commodities or whatever it might be. But there are some, I think Victor Niederhofer has a section on his, or even a book on trading psychology. And I think it's very important to be able to have the mental capacity to experience some of these drawdowns and how to deal, not to experience them, but when you do, to be able to deal with them and not to celebrate in an extreme fashion when you're doing so well and when you're doing so badly then to hit the lows. Like, how do you deal with that? Do you try to justify things? Like you were saying, you get on your calculator and you look at your fees and then you're down, how do you deal with that? Because we are at the end of the day an emotional species and we do have all those feelings that we have to try and express, but unfortunately in a way, well, maybe not unfortunately, but we have to manage them when it comes to trading markets.
Okay. So back in the day, I met, what I think what was causing my inability to pull the trigger and start a fund, post Bear and J.P. and all that, was the unwillingness to feel stupid. I didn't like to look stupid. For a long time, I was the man. I was always the tall, good-looking kid in class who was always good at every sport. I got every girl I wanted, I had a lot on the line to lose if I did something and made a mistake. Up until this point, I was, pretty good. Good baseball player, and then went to go work on Wall Street. Here we go. All right, great. And then, so now this is something new for me. And I didn't like to, I didn't want to feel stupid. So at some point in 2010, I had been reading Ed Sekoda's Trading Tribe website for a while, and there was a couple in New York City, or maybe there was one active at the time, and I joined that and got the help from other guys in the tribe going through the processes that we do there to kind of feel the feelings, like feel all of our feelings and see their positive intention. And most of us don't see the positive intention. We just, when we start to feel something we don't like, we medicate it with something. If we're sad, we go watch a funny movie or, have a drink or whatever. Rather than saying, okay, what can I do to proactively get to the root of what's causing this feeling in the first place? We likely, this is a little side tangent, we likely have no control over how we feel about things, but we can have control over how we respond to the feelings that we have. So that feeling of not feeling stupid, I was medicating with, I'll just put myself on the sidelines. Or we put ourselves into the code, into Excel, one more test, right? A little more tweaks, just some more time. And what happens? Opportunity just pass you by. And it happened to me. I saw it in real time, in 2010 was another great year for trend trading. I missed it. And then what happens? I medicated that frustration of missing opportunity with impatience now. Then I rushed in. And then what happens? You call the top, for a while at least. And so those things, and it's funny because we're starting a new tribe and we actually have a meeting next Monday. You got some guys that want to do some work and me too. But yeah, when they come up during trading, since I've been trading over the last 8 years or so, I always know that the right thing to do is to follow the system, right? If I could just do this, right? It's a game, almost like, it's a test against yourself sometimes. Sometimes it's really easy to follow it. Sometimes it's hard. You got a bunch of losing months in a row. You're like, Jesus Christ, it's like, there's nothing I can do to win here. Like, or in my case, in a bunch of our cases, it's been a nasty 5 to 10 years. So executing in the face of that, I feel I get the appreciation for sticking to the system as the right thing to do just through the research and just through the, talking to other guys like Jerry Parker and hearing their stories. Jerry has a whole lifetime ahead of me, 35 years ahead of me, and hearing how, oh, you make mistakes too. Oh, okay. So you feel these things too. You're not some god who doesn't, or some robot god who just follows every signal. No, these guys make mistakes too. And, they're still good. It doesn't kill them, but they're susceptible to. And so I just think seeing other guys do it and seeing other guys talk about it, and relaying that back to how I feel, during, sometimes when I'm executing my system, like, oh yeah, this is the time when it's really, really frustrating. But yeah, I remember Jerry saying, times when he felt that too, and he didn't take that one signal, and then boom, that was a good trade for him, and it would have really helped his performance. All right, let's not do that, because that's the wrong thing to do, and that's going to lead to more frustration, likely lead to more impatience, and maybe I'll compound the error by trying to make it back really fast, or do something else. I'll leverage up this position over here, and then what happens? You leverage up at the top, and it reverses, and then you miss a winner, and then you compound, add to a now soon to be loser, and it's all fucked. And, I think that yeah, I just think, for me, it helps just being around other guys doing it and seeing and hearing their experiences. But I always fall back to, if I just do this, I'll be
and that's
good.
the thing with the stock market. The stock market doesn't care who you are, what your background is, whether you've been a success all your life with other things. They'll just move in whatever way you're trading, whether you're a trend follower or any other type of trader. The market at the end of the day is always correct, even though there are theories out there suggesting that markets may be overvalued, and in reality as well too, if you can spot those, if that's any way possible to spot. The market doesn't care who you are. So someone who could come out with an MBA in economics or whatever it is with an economics background, and someone who is a high school student, the high school student with no official degree could outperform somebody who has apparently the qualifications to be a success.
Yeah, it's going to do what it's going to do, and it's your job to align with that. When you try to impose your will on a cosmic force, you're dead. You're not going to win that fight ever. It's too big. It's too strong. It's got too much lasting power. Our job is to really just align with its trend. And sometimes we're going to get it wrong, right? We're going to have a lag. It's going to change, and we're going to change a little too late sometimes and change too early some other times. But that's just the way it goes. Yeah, you just hope you're available for some good moves from time to time, and you're there, and you have your mindset and your discipline are clear, and you're stable, and you're not fighting yourself. You don't have your own issues while you're trying to navigate these things, because they're nasty enough to navigate. It's easy for, the waves on the beach are going to come in and out regardless of if there's any surfers out there. It's going to just do what it's going to do. And all right, if you want to play this game, surfing the waves, then okay, you better learn the nature of them and then practice and do all that. And if you have your own issues, though, of impatience or frustration or fear or this or that, you're likely going to be misaligned at some point. So I think the nature, or say like the rules of trading the markets are pretty easy. Just like diet and training, they're pretty easy to get fit and lean and healthy. It's just the hard part is just executing it day after day after day, forever, and having no lulls, no breaks, no impulses every time you walk past a donut shop. It's like, oh yeah, I really want that though. All right, well, you can have it. Just know that's going to, impede your progress. That's all.
That reminds me, all right, when I was trading personally using trend following methods as well, back in just before the crash. And again, you'd be looking at different ways of entering and exiting markets and identifying some entry points and buying into or even shorting some of the commodities or financials or equities. But I just recall, I think it was leading up to when there was quite a bit of volatility, just right before the markets kind of crashed. It was more sideways trading, I'd say, and there was a bit of volatility on that. And I just remember thinking, I wish I could just sit down and watch a football game without having to, be constantly thinking of I wasn't staring at the screen as such, constantly, but just remembering I'd love to be able to switch off. And that can be a very difficult thing to do.
Yeah. And I think back to the system, like if you have one, it's okay. That's what's a good thing. The other thing is to follow it and, follow it in the face of a lot of noise. And there's, for a long period of time, there could be just a lot of opportunity that, in markets you're not in or something that, or your buddies are making money and you're not for a while. And it's, sitting there day after day, one bar at a time, one day at a time can get, it can be draining. But I think, much more so than, we're going to do this back test and, all right, here's a 40-year back test. All right, this looks pretty good. But to live it bar by bar is very different. I mean, think about how many thousands of hours it takes to actually get to that end result, or how many thousands of hours the drawdowns take to get out of, or to get into and then get out of. It's like, oh boy, it'll really test you sometimes. But yeah, I mean, I think in the investment community, we're talking about the tactics and the rules and the strategies so much. Like, there's so many strategies you could do a back test for that make money. There's so many. But how come the average investor is always underperforming the indexes or their benchmark by 50% over every 30-year period? Like, why? Because they have no discipline. They follow it sometimes, or it's one or two big mistakes that screw them. And some people can watch markets and daily and stick to it. But I think every human, if the saying is true that we're pattern-seeking animals, if we're watching something every day, we're eventually going to see something like, oh, you know what, this is a buy right here. I'm short this right now, long term on my long term system, but yeah, short term this looks like a buy. You know what, let's just change this for for a day or two, while it pops. Then you start doing this over time, and then you start screwing your discipline up, and then again, it's just one or two mistakes, and then it really sets you back. Yeah, I don't watch markets every day. There's just no way you could do it, because what am I going to do? I'm not changing my system based on what's happening on a minute or hourly basis. So I know that's the wrong thing to do, and it's just information that's just not. I don't need it.
Mike, do you look at certain patterns like Fibonacci sequences or triangles or head and shoulders, things like that, candlesticks?
No.
Are you tempted to read up on the stuff,
Nope.
or you just prefer to, not to ignore it, but just prefer to concentrate on your own particular strategy? You never would be tempted to understand or embrace or perhaps use some of these, because if some people are using them in the markets in a way to become self-fulfilling, for example, if someone identified, say, an Elliott wave or even a double or triple bottom, that could suggest, or even, the way you have a bowl or a cup with a handle, could suggest a subsequent dip. And if more people believe that's going to happen, more than likely it will happen. And would you think like that type of trader? Because you can't fight, like, for example, if you were in Spain, that bull run, you're not going to run toward the bulls, you're going to turn around and run in the direction of the bulls and away from them. So do you kind of follow certain, like, who knows why markets turn up or markets turn down, but if it seems to be a sequence or a regular occurrence whereby double bottoms or triple tops or whatever it might be tends to follow a decline, or a rise starts to follow that, would you look for these type of ways of trading, or would you just leave it run?
No, not at all. I find a lot of times the simple long-term trend following indicators, breakouts and moving average crossovers align with those patterns anyway. And, with those patterns, they're very strict, I think. The guys that do them, they have trend lines, they have lines in the sand all the time. And if it breaches that a little bit, then they change the position around and they're chasing back in, or they just change like, oh, see, yeah, we're not going to go on the close candle. We'll go on the high low, intraday high low. So, we'll change this pattern now. So you can theoretically come up with millions of entries and exits that, it's not a system you can test if it's always changing. And that for me scares me. And I know that, well, if I can't define what I'm doing, then how am I supposed to do it? And that scares me. So no, I stick to the following trends approach, have a simple definition of a trend and go with that. And if patterns come up in favor of my position or not, okay, great.
Like, yeah.
But,
great. Like, I'm very interested in how you decided, or why you decided to set up Melissinos Trading. And it's amazing that you got initial investors on board at the beginning as well to get you started. Yeah.
I mean, what my motivation was, one, I'm an only child, and I've always been, individualistic, and I'd like to go my own way and, march down my own tune and stuff like that. But that Bear Stearns collapse and financial crisis really stung me, because I knew even if it turned out to be a great job and all that, that event told me that I really have no control here. And that scared me. And I can't ensure my survival here. And that scared me a lot. So how am I going to do that? Because those are my motives, to, protect my money and protect my job and, standard of living, way of life, and do it my own way. How do I do that? And the natural solution was to just start my own thing. And, I was, partial to the trend following stuff. And, I just told people, and in 2010, told some people about it, like, here's what I'm going to do. Here's what it is. Here's the philosophy behind it. Here's some historical performance of some other guys that I'm going to try to emulate, and here are the benchmarks and stuff like that. Just so, because the people I was going to at the time had no idea what trend following was, these were just the standard, buy and hold types, value type mindset, Warren Buffett type stuff. And they didn't know about this trend following stuff. So I just had to teach them a bit. And I had 4 investors day one, including me. And it was me, my dad, and a couple of uncles. And later that year, I got another investor, a guy I worked with at one of my jobs. And then in 2012, I just started getting more, smaller investors and put everyone into a fund. And $5 million later.
That's a great story, yeah?
Well, I mean, we need some, if I could express some frustration, we just need some fucking performance here. My God. It's just like, I can't keep telling everyone, all right, we're down again. Stock market's up 80, we're up 15.
Yeah.
The correlation story, the blending of the portfolio, squeeze me into a piece of your portfolio.
But if you look at any funds, I've looked at some funds, they're not even trend following, they're just maybe emerging markets or whatever. You're talking about 4.5%, for some bonds as well. And then there's a lot of costs involved, administration costs, and you're pretty much flat on this. I can't single out any particular one, but I did look at it there about a month ago. And I'm just confused, given that they're double-digit growth year on year almost with the stock market up until late last year. So I wouldn't. You seem too hard on yourself.
Yeah,
I know you want to be the best, or you want to do the best for the people that you're investing for. But as you said earlier on, you can't. You just have to let the market.
I know all that, but I'm telling you, in real time, and you know what? I've had a lot of frustration over the last 2 years. I smashed to pieces 2 iPhones, just punched them and just destroyed them. I didn't break my hand or anything, but my wife was like, you need to talk to somebody. So I was like, all right, you know what? Maybe this is a good time for Tribe again. Maybe I need a refresher here.
I recall things like that myself. I didn't break any phones or anything like that, but I took up a paintbrush and started painting the house. And I said I had to keep myself preoccupied to take my mind off it, and I painted and I did the garden and things like that. Yeah, that stuff. I like that stuff too. And I think those are healthier, more productive things than breaking a phone, like me. And I feel that it's okay. All right. If I break a phone, all right. Well, at least I didn't break my system, right? At least I didn't go against my discipline and change my rules around, or, not take this trade or double up on this one, or, whatever. So I stay away from that, but still, there's still that, internal rumbling of, I just want to win like everyone else. And, this is just a tough time. It's just not our time yet. It's just not. And that's like, okay, I know long term when I'm sitting here talking to you, or when I'm calm, okay, I understand all that. But, we're trying to run a business here, trying to, raise a family here, all that stuff, those pressures. And, we don't live for 1,000 years. There are a lot of pressures, aren't there?
Yeah, they're just, like. People
are depending on you.
Yeah, it has to be timely, of course. Like, it's not a theoretical experiment here. So all those things make it more difficult. I'm sure maybe some of the older guys, the guys I learned from, are maybe a little calmer. If they have $100 million in the bank, or $50 or $20 million in the bank, I'd be calmer too. But we're not there yet. And
but we could be talking in 10 years' time, and we might look up back on today's conversation.
Maybe, yeah. I mean,
it's all good.
The story you told about Dalio, that Niels told about Dalio. I mean, how great of it would have been to have a podcast when he was going through that, and then having one 10, 20, 30 years later, right? You get to like actually hear it in his voice. You get to see his evolution of it. I mean, hopefully we get to be able to do that stuff now. And
even Niels was saying that these drawdowns, they're scars, but they're battle scars. And when you survive, they are like a metaphor for survivorship.
Yes. Yeah. Yeah.
That you're able to get through this, you know?
Yeah. I feel, and every strategy has that way. Every asset class. We're not talking about it in the stock market now because the last 10 years have been great. But for the previous 10 before that were awful. Or let's say the previous probably 15 or 13 to 15 were terrible, for the indexes at least. And those indexes are perfect precision discipline with no fees, right? Then you got to add on the person doing it with poor discipline, and then fees, and then mistakes, and then the returns get much, much worse. But right now everyone's loving it, and everyone's like, "Oh, why are you doing that?" Stock market's great. It's like, yeah, well, it's not always great, and this is our lost decade, or this is our great recession, if you will. And, the opportunity now is to kill us, and you're not killing us. So soak it up now. Soak up all of your rah stuff now, because sooner or later we're going to come back and, we're going to get you. But, right now we'll take it. I'll take it on the chin.
Mike, you've referred to a couple of people there, Jerry Parker, and we mentioned Ray Dalio and Mike Covell. Do you have a number of books, if people were to be, or even blogs, blog posts that people could refer to in order to introduce themselves to trading and also trend following and what to look out for? What did you find beneficial yourself?
Yeah, definitely I think now more and more, it's these podcast interviews that I think are great. Listen to every Jerry Parker episode ever. Go listen to, if you want to learn about trading, I know you have some non-traders on your podcast, but if you want to learn about trading and psychology, listen to every guy on your podcast, Covell's, Niels. There's just so much wisdom there, and there's so much experience that, I think for young guys, they may feel picked on sometimes when things aren't going well for them. It's like, no. Other guys have been through this too. Relax. Just go listen to them. Go talk to them. And if you want to learn more about like X's and O's and trading, and I never really read any books on how to trade, like how to build a system, but there's a couple good experiments on Ed Sekoda's website that you get to build a simple trend following system. Again, this is all going to be trend following, but if you want some experience in Excel and stuff like that to build something, he's got some good stuff on there. I definitely think the Michael Covell trend following book was really good for me. It's not just here's a system, go test it and good luck. It's here's the thinking behind it. Here's all that. It's not just some rules. I think reading that stuff just doesn't work at all. It's just, maybe you'll trade it for a while and get lucky for a bit, but eventually when you start losing, you're going to understand, wow, yeah, I need to know myself better. I need to know the reasons behind this type of style that I'm doing, all that stuff. And I think those books really helped. And I still love the Market Wizards books. I mean, again, because it's more wisdom from the guys doing it. And I feel that the rules themselves are just, they come easy. To me, it wasn't a lot of work. It's all the other stuff. It's all the philosophy and the thinking behind it.
Yeah, you see, I'm going to definitely check out Ed Sekoda's website just to see his own system. I looked at the Turtle Trader system as well. I know Jerry Parker has tweaked it a little because things have changed over time, or people began to adapt to the system, even though it was supposed to be somewhat.
Yeah, I think I told him one day over coffee, I said, man, you guys got lucky. That Turtle program, man, you guys got lucky. Because, back then, the environment was just perfect for short-term trend following. It was great. But today, no. Even in the last couple of decades, no. I mean, maybe it'll, come that way again and things will be really great and, short term will be where it's at or something. But, there's no turtle program today. And I say with that success, that means the results they had were insane. And I recall seeing Ed Seykota talk about this too, where he started, I think it was late 60s, and he made a couple 100% for years on end, I think was the quote. So, wow. Whoa. Like, who's doing that right now? Other than some, small account guy, day trader, something like that, that's killing it for a little bit. But doing this with a serious account size, like, absolutely not. You just can't. Yeah, I mean, I was, half joking with them that you guys got lucky. Obviously, they learned, from really smart people, and Bill Eckhart and, I forget the other guy's name. The guy who started it, I forget.
Richard Dennis, sorry. God. Sorry, Rich. But it was really great experience for them, and, they learned a ton. I mean, a lot of them still have great businesses, even today, after 35 years since then. But I'm saying that back then, if you guys started with longer term, maybe like as you mentioned with Jerry, tinkering and changing the system over time. Yeah, they went from a short term to a longer term. It's like, well, yeah, longer term, over many, many decades or centuries is just much more robust, because the short-term stuff can be more susceptible to not working for an extended period of time. And in that time, you might still make money, but your losses get really big in relation to your gains. The long-term stuff just seems to hold up better, like have better Sharpe ratios, have better MAR ratios. Those of you who don't know what MAR is, just compound annual return divided by the max drawdown. For shorter term systems, those ratios get pretty bad. Longer term stuff seems to hold a little more stable. But I'm sure they have their own algorithms or their own programs that's unique to those. Do you have your own, or have you purchased a program that you have tweaked a little to suit your own trend following needs?
No, I have my own. I did everything by hand for a long time.
Okay.
In my testing process, because I wanted to actually see. I wasn't a programmer. I had no experience with trading systems or this trend following trading before. This was like, 2009 and 2010 before I started it. And, I wanted to understand every order, every trade, what it felt like, as much as I could, to sit with these positions and go through, as I said before, bar by bar, day by day. It's too easy, and I feel like running these tests on these prepackaged systems, or if someone just gave you, your friend, or like, let's say if Jerry Parker gave me his system 8 years ago or 10 years ago, and I tested it, and, would I be able to stick with it? Like, probably not, because I don't even know how it works. So anytime it starts losing, I'm going to probably freak out and say, well, is this normal? I don't know. Am I supposed to be losing this much? Should I be making money? Am I doing this right? You don't know anything. So those quick tests that take 2 minutes and you get a whole 30, 40 year back test, and you don't really understand where it all came from, or why this is happening, or why we're making or losing money here, or this or that. So yeah, I like to started my own thing, just started testing a whole bunch of different stuff from all the material that I read, from Covell's book, and looking on Ed's site and things like that. And then I went from there. I think the most, probably, if you want the rules, I think Covell's Turtle Trader book had like the system in there. And I think there's that's probably an easy place to start. Maybe there's some other sites too. Maybe Andreas Klenow has a couple of books. Yeah, maybe his book too, Following the Trend. He has a stocks one too. I think it's called Stocks on the Move. He has some like simple systems in there, but how many people read it and just put it down and never do it? Yeah. Everyone.
There's another one that I thought was very good at the time to be introduced to trend following. It's a very short book. It's one by Mark Shipman. He's an English trader. The next big investment boom, learn the secrets of investing from a master and how to profit from commodities. And it kind of spells out clearly the trend following and entry and exit positions. I found that quite useful. But I'm just wondering, how much does gut instinct play in for you? Or again, is this something that you keep separate? And has it ever materialized that what you had a gut instinct for an entry or an exit, but you never followed because it didn't match up with a trend, did it materialize that could have been the right decision to have made? I know hindsight is 20/20, but if you were true to your gut and not kind of think, I could have traded out of that or into that at the time,
Yeah. Okay. And I believe it was 2016. It was whenever when oil bottomed. It was down at like $25, $30 a barrel or something. I remember getting a lot of emails, texts, and just seeing much more commentary about people. I had two investors that actually got short at like 35 or 40 or something, like mid 40s maybe. I'm like, now you're getting short after the thing has fallen 70%. And then I have some other people who never talk to me about oil or trading in general, and they're talking to me about this, and said, this is probably a bottom. This isn't good. It's probably time to close this short position out. Because at that point, I had been short for like 18 months. Just kept rolling it, and was short from, I think, the mid-90s down, all the way down. And that was a great trade. But at some point, obviously these things don't go to zero. I remember at that point having that instinct, and I didn't do it. But then I believe it was December of last year, 2017, I don't trade Bitcoin or anything, but the same thing happened again. All this texts and messages and calls about Bitcoin and all the jokes, and seeing other people who actually created Coinbase accounts to trade it now and to invest in it. I said, this isn't good. I don't trade it. It's not going to benefit me. But I remember I wrote something on it, and I wanted to look at the price move in Bitcoin versus other bubbles throughout history. And I looked at the NASDAQ bubble, a couple of the stocks like Costco and Amazon, sugar in the 70s, soybeans, I believe, was one, gold and silver and crude oil. Maybe there are a couple other ones in there too. I measured it by what is the difference between the price and the 300-day moving average. And Bitcoin, I think that the higher ones, I think Cisco and Amazon were two of the highest outside of Bitcoin. I think at like 200 or 300%. The price was 200 or 300% above the 300-day moving average. So it like really extended, like, went vertical, right? Total hockey stick. And Bitcoin at the peak was 500. I couldn't find anything higher than that. And that, I said, okay, that's a top, or this isn't going to continue. So I wrote that, I think it was a week or I don't know, a couple of days before, after the eventual peak. And that was like another time. So I don't really have any gut when I look at a pattern, really, because you can just start seeing patterns that just aren't there. And like or now I'll start seeing a lot more potential opportunities. Why? Because I'm in a losing streak and I want it to happen so bad. And, things like that, so those things cloud me. So I don't trust that as much. But when I start to see a lot of chatter and a lot of, just buzz about this market or this move or something like that, I start to look and take notice. But again, I haven't made any decisions where I pulled it quickly or took it off or anything like that. I haven't done that. Maybe at some point I would, and I read Ed Secota's FAQ a lot. And I go back in time. It's been up and running since 2003. So there's 15 years of email interactions between Ed and people who write in. I remember him saying that, he takes notice of that sometimes too at conferences and stuff like that, where a lot of people are bullish or bearish on a particular market or something, or magazine covers. I think he always pays attention to as well.
I was just going to say, yeah.
Yeah, stuff like that.
If something is on page 30 of a magazine and then you find itself in the first 5 pages or on the cover, then you'd have to be very cautious as to the peak of that particular price.
Right. I think the last one was the dollar in 2014. I believe it was The Economist who posted, the dollar with George Washington was on the cover. I think it was entitled The Mighty Dollar, and that was the top. That is more artistry, and I believe like good poker players, like knowing when to bluff and knowing when to stuff like that. I think just comes with a lot of experience. I think a system, the rules, the hard coded rules, following them is really good. But if you can obviously work in some of these hunches from time to time, these bluffs like guys do in poker, after a lot of hands. This isn't something you do in year one or something like that, where all right, maybe you do, maybe you have good intuition, and you have some better than me or something. But okay, great. But for most people, I think they need a lot of reps before they start to develop that, and I haven't done that stuff yet. Maybe in the next, I've only been doing it for 8 years. Maybe I'm ready now. I don't know. But
even when oil peaked at $150 a barrel, there was a news reporter who was flown out to an oil rig to report on this high price of oil, and that was actually the peak as well. So that's an example of another one whereby you'd have to observe and take that into consideration. Even house purchases, when people who aren't normally buying houses or properties or second homes or holiday homes, when they're the typical type of people who don't purchase it, again, you need to be worried about the peak of house prices. And I suppose there's a famous quote by Mark Twain: whenever you find yourself on the side of the majority, it's time to pause and reflect. And it fits in perfect there with what you were just talking about.
Mm-hmm. Yeah, and it's another thing I don't use is the commitment of traders reports, but I bet some guys use that stuff too to kind of weigh whether trades are crowded or not. Again, maybe that's something you can add into your calculus at some point, just to kind of. But I think I bet at the time, I don't have the data in front of me right now, but I bet you when oil bottomed, the position was very, very, very high. The short position by speculators and the long position by commercials was very, very high. But that doesn't always work too, because in 2008, during the oil move you just mentioned, the speculative position, the commitment of traders was declining. The long position for speculative positions was declining for like 100% of the move. So you never know. That's why it's like, the commitment high. Let's pull this off, and then you watch it go another 100% without you. You're like, oh my god, that you can't afford to do that. So you need to be really careful, because I don't know. It's a lot of times it's not worth it making a big mistake over some of these intuition stuff.
Mike, I'd love to go on and talk to you more. There seems to be a mini series of trend following, because I just had Michael Covell and Niels Kastrup-Larsen, and I also had Jack Schwager a couple of years ago on the podcast. So I'll link all these on a web page for yourself on my own website at economicrockstar.com/Mike Melissinos. And if anyone wants to find out more about you, Mike, will they visit melissinostrating.com?
Yes, that's a good place to find me. Also on Twitter, LinkedIn, all that stuff too. So yeah, just type in my name in there and you'll find me.
Great, Mike. Mike, thanks very much for coming on the show. Really love talking to you and the insights, and I hope you have a better day tomorrow. And just like to say, you are an economic rock star, if that makes draws any comfort in the day for you.
No, it does not. Well, thank you. I'll take it.
Mike, have a good day, and I'll talk to you again soon.
Thanks, Frank. Appreciate it.
All the best. Economic Rockstar is a free podcast that does not exclude anyone from listening, as long as they have a device to listen, download, or stream. I have many listeners from all parts of the world, and I truly am pleased to know that the Economic Rockstar podcast unites all of you through the common theme of economics. I strive to commit to releasing an episode each week and aim to develop Economic Rockstar into much more than just a podcast. Patreon is a platform that gives you, the listener of the Economic Rockstar podcast, the opportunity to express your appreciation of the show by committing a financial reward for as little as $1 a month. Patreon allows me, the creator of the Economic Rockstar podcast, to be rewarded and paid by you so I can continue with the running costs of the show and to reinvest and expand the podcast into other platforms or mediums in the future. To find out more on how you can help the Economic Rockstar podcast and have your name added to the supporters list on my website, please check out my Patreon page at patreon.com/Economic Rockstar or visit the supporters page on the Economic Rockstar website. If you enjoyed this podcast, why not leave some feedback or comments on the show notes page on economicrockstar.com, where you can also sign up and be a member of the Economic Rockstar community. If you're listening to this episode on iTunes or Stitcher Radio, I would love to have some feedback and for you to leave an honest rating and review, as this will help with the rankings of the show so that more people can find it. If you're listening on the website economicrockstar.com, make sure you check out the back catalogue of all previous episodes and interviews with some amazing professors and authors at economicrockstar.com/podcasts. Thanks for listening, and I really appreciate your loyal support. I know how much you love audio, so why not get a free audiobook with Economic Rockstar today? I've teamed up with audiobooks.com to bring you this amazing offer. Visit audiobooks.com/rockstar to download your free audiobook now.